Hello, welcome back to the Instech podcast. Zoya here, and this week Matthew Grant is joined by Matthew Eagle at Guy Carpenter. Over 30 years in reinsurance has given Matthew Eagle a rare perspective, from the early days of catastrophe models through to today's world of AI and agent-driven analytics. In this episode, you'll learn what it really means to be a trusted advisor in broking, how to balance growth with volatility, and why capital optimization still sits at the heart of insurance success. And with AI now moving into underwriting and pricing, what skills do tomorrow's analysts need to thrive? Just to note, this episode reflects a perspective on AI in analytics and model development at Guy Carpenter, but it is not to be interpreted as representing the company's overall AI strategy. Now let's dive into the conversation.
Matthew, it's great to talk to you. A lot of our guests I've known. I don't think many of them I've known as long as you. I think we've known each other for 30 years, saw you as an analyst, and now you've got a global role. So thank you for taking some time out. I know you've got a lot going on. It's great to have a chance to catch up.
Thank you. Pleasure to be here.
So we should start off with the role and what you do. So Guy Carpenter, one of the biggest reinsurance brokers in the world. You are head of global model solutions and advisory. What does that actually mean in practice? How do you explain that to your family when they ask you what you do?
Our team support all of our clients and our teams in the different regions to help clients develop a view of risk with respect to catastrophes. And I guess that's both man-made as well as natural perils. So we do a lot of the evaluation of third-party models and development of our own model solutions to advise our clients.
So Matthew, there's a lot of talk today about how data and analytics are helping insurance companies, brokers, a lot of changes going on. But of course, 30 years ago, we were both looking at this. It was the early days, but it's not like it's new using analytics. And in terms of what you're doing for your clients today, what is the key aspect of how you're helping them be successful with what you're providing is in your broking role, but also in your sort of analytical advisory role?
It's definitely evolved. We know that our primary role is still to help our clients secure reinsurance capital at competitive prices with market-leading coverage and obviously with good counterparty security. That's the sort of bread and butter of our role as a reinsurance broker. But really, we view ourselves as a trusted advisor to our clients. How can we help them successfully manage their business? And we simplify it into primary objectives of clients as profitable growth, managing volatility, and optimizing capital. And a lot of our analytics advice really supports that. So how can we help them with growth in new territories or new lines of business? We're increasingly doing a lot of work to help clients, particularly on the natural peril side, on the underwriting side, and portfolio accumulation. But clients, as I said, they want to generate stable earnings and minimize volatility. So helping understand all the material drivers of risk and structuring reinsurance that help them manage that earnings volatility with respect to their own risk tolerances and own risk metrics. And then I mentioned finally, the important one of optimizing capital. So we really need to help clients understand tail risk and then make sure we can structure reinsurance and capital solutions so that their solvency margins, solvency ratios meet the requirements of the different stakeholders, whether that's regulators, rating agencies, shareholders. So I think it's really evolved to that trusted advisor to help our clients with their business. And I think industry and peer benchmarking is never far from that. That's a key role of us as a reinsurance broker, being able to bring those insights into market trends and that benchmarking for our clients.
I want to come back to those three because that's just a sort of great way of summarizing what insurance is all about, how to be successful in insurance. So you had profitable growth, but particularly when it comes to catastrophes, you've got to help your clients manage the volatility. And then thirdly is optimizing that capital so that they're actually getting the best return on that capital. That wouldn't have changed if we did talk 30 years ago. In those days, I didn't know what insurance was. So if I'd asked you, you would have told me and it would have been the same three things. What has changed, of course, in the last few years, and this comes back to your point about an advisor, is how AI is entering the world, agentic AI now. I'm sure that's a big part of what your clients are asking you to advise on, is in both in terms of how they can use it and how they can get more effective solutions to what you're supporting with them in those areas and others.
Absolutely. And it really goes to the advice and the insights. But I think one thing actually maybe to start on is our clients need and expect us to be as efficient and streamlined as possible. So I think it's fair to say that as many of us, both as us as brokers, but insurers and reinsurers, where we are on the AI journey or where we start is often on the process and the data. So there's a lot of work that's going into trying to get data in good foundational order. A lot of the machine learning and large language models really require access to information data on which to be trained, taking advantage of data standards to create tools to automate data conversions, for example, utilizing APIs to execute models and generate standard reports, scaling our own and automating our own model building process. Here in the UK, for example, a lot of our clients provide their exposure data in their own formats. And we've created apps and rule books that really allow us to convert that data straight into what we call a universal file standard, but it's effectively based on the Oasis open data standards. So if the data has to get updated, we're literally just repointing and running that process. And increasingly, that process at the moment is effectively an app, but that's going to be executed through effectively an agent AI tool that's going to be able to know what to look for and how to process things. And we go from clients' raw data through to files that can go into the models with a click of a few buttons. So, well, actually in the future with a few commands.
Then how do you think about this build versus buy decision? You get some competitive advantage building this yourself, but that's back to your 3 points earlier about what you do. That's not the key strategic offering. You've got great efficiency, but how do you decide whether you need to build it yourself or you should be licensing somebody else's products?
Yeah, that comes up on almost in my role, at least on almost a daily basis. And the technology is moving very quickly and it's enabling a lot of new entrants to the market. And that's one of the reasons we joined Instech and want to be part of this group, is really to be able to provide access to that increasing community. But it is challenging because sometimes it's quite daunting and overwhelming how many potential partners you have. And one of the skills is going to be, how do we adapt ourselves? How can we adapt fast enough for the change in technology to be able to understand the benefits of some of these new data entrants and new companies are offering? So there's a lot of time is spent evaluating and talking to third parties and understanding what they can bring to the table, and trying to then weigh up that question of, I don't think we can be experts in everything. Increasingly, we have to understand that there are, because it's moving so fast, there are probably people out there with stronger skills, but we have to be able to take what they can do and integrate it into our own work. And ultimately, we also want to make sure we manage dependency risk. So the build, on one hand, gives you that ability to be in control of that. And so how do we take some of that third-party technology and data and integrate that into our own process? It's an ongoing debate, and it's not one or the other. It's getting that right balance, I think.
I'm sure you get a lot of companies knocking on your door, but in terms of their understanding of what's actually needed, my impression is that these companies are getting more sophisticated, and you probably wouldn't get somebody saying, hey, I want to try and sell you a new hurricane model. Is that your experience, that people are pretty sophisticated now?
Yeah, and I think their understanding and knowledge is improving, and a lot of this they get from dialogue with people like ourselves to do that. And we do have to ask those relevant questions, because we get people knocking the door, and sometimes for me, it's more immediately obvious that really this is a solution that's more better served up directly to an insurance company rather than through us as the insurance company's broker, and we might make that introduction, if you like. So we've got to really understand what's the use case it's trying to solve for. Is it really helping on the original underwriting? Is this going to be useful in an event response type situation? Is this going to help us with portfolio analytics? Which ultimately, when you think about the role of a reinsurance broker, we tend to be operating more at the portfolio level. So really just trying to help the startup or the new company understand what they have and help them work out where it's best suited, and then for us to be able to evaluate whether that's going to be something we want to embrace or something we want to help introduce to our clients.
You have got me thinking, probably not 30 years ago, but maybe 25, 20 years ago, when all the major reinsurance brokers saw the value of models, back again to the points before about managing volatility and capital. In a sense, the brokers were the big investors, along with the Bermudan reinsurers, in modeling technology, and grew that business because you saw such a strong use case for it. So it's kind of interesting, because that was the kind of the first round of models, and then now it's probably there's more choice, but it's not starting again. You're now again fulfilling that function. But I guess the challenge for everybody, which sometimes people forget, is you can have excellent information or analytics, but there has to be an ability to pay for that. For you, because you're involved in the transaction and there's only a certain amount of margin you can put towards analytics, or for the insurer who has to pay for it out of their premium, isn't it? So it's not just being technically strong, it actually needs to be at the right price to be able to be acceptable to the end user.
Yeah, and I think that's where we also have to understand when is good enough, and because ultimately there's a cost involved in getting more data, more granularity, more information. And I think just trying to understand what problem we're solving for and making sure that the solution we're putting in place, ultimately we're trading risk. Someone's effectively buying reinsurance, someone's selling reinsurance. We're trying to make that a win-win, that we can come to some understanding of the risk. And in many cases, there's certain methodology and a certain level of data is going to solve the problem that we need. But it has changed over time. I think you went back when we started, so much of the focus was on capital and tail risk. I remember even people used to only show, EP curves above a certain return period because they didn't, the models, the computational intensive calculation, we didn't have the computing power sometimes to solve for building models. Whereas now we're solving a different problem. For example, 2 years ago, we had the big increase in retentions in the reinsurance market. And a lot of our insurance company clients are now retaining more risk, but particularly risk from climate-related perils like flood, wildfire, severe convective storm. So now we need models and data sets that help, price that original risk and model the accumulation of risk. So what am I writing that I might be building up wildfire losses or flood losses that I'm going to end up retaining? So a lot of our clients have an increased focus on portfolio management and not just worried about, capital and tail risk, which obviously is still important. And it's one of the areas that CAT models do, right, to help us extrapolate out into the tail. But really understanding portfolio accumulation has been one of the changes, I think, in the last sort of 10 years or so.
Yeah, so I just with a quick add for people that don't speak catastrophe modeling. So EP is exceeding probability, and then really what we're talking about is a severity and frequency issue. So traditionally, you said modeling was really focused more on those low frequency, high severity events. The resolution of what you could model at was not so robust. But now, to your point, partly because reinsurance is getting so expensive or not there, companies are now having to absorb these much more frequent events. And actually, computing power, and it gets us back to AI, is actually there to be able to do it. But it does lead me back to something you mentioned briefly. But what does that mean for the people you're bringing into the business? Because traditionally, you would have primarily, I guess, hired people with strong earth science or sort of geography backgrounds, strong analytical backgrounds. But now you've got that whole dimension of how to very quickly understand what's out there in terms of the tools you can buy or license for AI, agentic AI, generative AI, all the different ways you can actually add value. How do you train for that or staff for that?
Yeah, and I think some of the individuals are training for that in themselves in terms of their own skills and developments. But definitely we're seeing the benefit for now from having analysts with really good data handling skills, good programming, coding skills, alongside, as you say, not just the peril expertise and natural science expertise. So that data processing, coding skills has become important. But I think we also want to harness those skills alongside the insurance domain knowledge. So the ability to understand how the business operates, how our clients, what the needs and challenges of our clients are, and be able to communicate, the insights we're finding from the data to the clients. So I think we shouldn't ignore that we increasingly need those skills, and a lot of that can just be applied. But ultimately, the real benefits we're going to get deeper insights, more insights, and we still need to understand the domain, the insurance domain, and we need to be able to communicate. So one thing I think we also stress is not just about what new skills we need to hire, but how we develop the skills of the people we already have in our organization. So making sure we have enough time for people to train themselves. It's not about people going off and doing pet projects, but trying to understand the problems we're really trying to solve and giving people enough time to hone those skills, learn new techniques, and test some of the ideas on those problems. So I think it's both hiring new talent, but it's also evolving the talent we already have in the organization, because those people in the organization, many of them, already have a good understanding of the insurance and reinsurance business.
And then you talked before about just now getting into this sort of what we call attritional losses or more high frequency events. What are some of the perils in particular that you're looking at? Because in addition to working with third parties, you've got your own teams of research and you actually build some of your own analytics. What's particularly relevant just now that people are working on, you're looking at?
Well, I mentioned earlier that increasingly we're asked to help our clients on the underwriting side, and I think about catastrophe risk or natural peril risk, I should say, on that. So developing risk scores and risk rating data sets for our clients to help price original business and, as I said, manage those accumulations. So the climate-related perils obviously come to the fore on that. Flood's been a key one. There's been a bit of a gap in the global vendor market, less so now with new companies coming to the fore. But flood is also one where there's a fair amount of consensus on the impact of climate change, on what that might do. So a lot of helping clients look at what the risk is now. Are the models fit for purpose? Are they keeping up with the impacts of climate change that may already have happened? And then what's future scenarios look like? But alongside flood, wildfire, we saw what happened in California, but going on around Europe. So wildfire has been an increasingly important one, and severe convective storm. And all three, in a way, have a fair impact from climate. We don't drop and forget, tropical cyclones key, hurricane, earthquake is key, but some of those additional perils have been driving some of the global cat losses, increasing demand from clients to understand.
Yeah, the list is getting longer, isn't it? You look back on 30 years of experience and where the major losses have come from have not always been what people expected. And then it's looking a little bit forward with agentic AI or generative AI. What do you think you'll be offering your clients 12 months' time, or what would we be talking about in 12 months' time if we were reviewing what you're doing just now?
It's what we can do to make our process more efficient. But I think the one area that I definitely think is occurring right now at clients is how to use AI on the underwriting process. I definitely think we've seen a fair amount on data cleaning, data augmentation. But I think ultimately the ability for a certain type of risk to be able to automatically quote or bind on that, I think there's going to be a certain bucket where you can present through an AI agent the information that's required to make that decision and potentially train a pretty consistent and reliable decision for that agent to make on your behalf. So that's more at the insurance end, but I do think that's probably one of the main areas that companies are exploring at the moment. I think for us, we talk quite a lot about CAT. I think one area maybe to think about is it's happening on our actuarial side as well. And all this only really happens because we've now got all of our actuarial tools being executed and the data being stored in the cloud. So we're creating agents that effectively utilize large language models. Firstly, they just investigate the data. So, for example, what's the frequency of losses for my clients? How does that frequency of losses compare to last year? Can you generate me a large loss listing? And even that almost needs its own large language model's own language, because you need the tool to be able to understand the kind of questions. So when you say, what's the frequency of losses for my client? The agent needs to know, I've got to go and find the number of claims. I've also got to find the number of policies and then divide one by the other, and that's going to give me the frequency. So, but that's happening. We're getting these agents that can effectively give us the answer to those questions. And then we're moving it forward to reinsurance pricing. Can you price me a 3 million excess, 1 million layer reinsurance treaties for a certain tranche of losses? And again, we can throw those kind of questions at these agents and they'll answer on our behalf. So we're seeing some quite exciting development on the pricing and actuarial side, as well as what we were talking about earlier on the cat exposure side.
Intriguing about that is you're much more focused around the data and the numbers. You've got identifiable data you're working with. It's very different than some people's early experience of generative AI and the risk of hallucinations and the original ChatGPT type models weren't very good at doing analytics. What you're talking about is in a sense completely different, because it's actually harnessing actuarial tools. You're kind of teaching it, or your skill is to ask the right questions. You've got data that is reliable. And so it's back to where you started. There's an efficiency about how you get that answer out. And then where it's exciting is now you've asked that question. Now you can start to apply it to the decisions you've got to have your clients with, and you can start to stress test it by lots of different scenarios. I think people sometimes occasionally lump everything AI or generative AI into one area, but actually it's breaking off into a whole lot of different areas, isn't it, in terms of where you can trust it, and it can be completely reliable versus you've got to put some caveats around it.
Certainly the trust angle that everyone sort of talks about a lot, and that's going to be key. But I mean, firstly, in a way, the agents are just doing a series of tasks. But as I said earlier, you're almost developing the new language so that they understand the commands that you're going to throw at it and that you're going to ask. But it really comes down to the quality of the information and the training, and that's going to improve over time. So I think we have to start now. The technology's there, but the quality of the answers and the reliability of the answers are going to develop over time as we're able to train these tools on better data. So we're not going to blindly take an answer to what's the price of this reinsurance treaty, but we're increasingly going to develop the tools that do that. And then I think over time, we would hope that interactive process can be done, and it could be done together with our clients because of pointing at data that we're going to access from the room and ask the same questions. So I think it's exciting what could get there, but you're right. I mean, that domain knowledge and that understanding of the outputs is going to be very important while we train these models on the data we have.
And then, Matthew, what's your view on where we are with property information? People have been talking about digital twins for a while, and of course, good property information underpins all analytics, because if you don't know what you're insuring or modeling, you're going to get a very imprecise result, which might be okay at portfolio level. And this is a kind of confidence thing as well. Where do you think we are on that in terms of actually data sources now being reliable enough to use them for analytics as opposed to what you might get from your client's original client or broker?
It does vary a lot, right, by geography in terms of, I think there's a lot of pretty reliable information on property attributes. Maybe one of the ones that still has debate is the valuation of some of those exposures, and we get people do that slightly different ways and may arrive at slightly different valuations of what a rebuild or replacement cost might be. But some of the attributes on buildings and properties, I think, is growing. Some of it is a mixture of paid for commercial data, and you get what you pay for and you get some quality, versus, you know, what's also going to be available out in the public domain. And particularly when we think about the protection gap and our work in the public sector and the developing world, a lot of initiatives going on to spin up, you know, exposure data sets that we could all utilize to solve some of those challenges. Now we know our clients of how can we sort of take the best of all, if you like, and because sometimes it's not all from one provider, and we can somehow bring that data together in a almost like a marketplace where you can augment with the best information you see for the purpose you're using. But we've made a lot of strides in the last 5-10 years in that area.
Good. And that brings us on to one of the other many hats I'm sure you wear, which is you're on the board of Oasis, the loss modeling framework. For those that don't know Oasis, they were set up by Dickie Whitaker, I think probably almost 10 years ago now, as essentially a way for providing an access to the market for models that might not necessarily always get there on their own, although some of the models are independently. You yourselves, as Guy Carpenter, release some of your models through some of the Oasis tools. As a big supporter of Oasis, what your vision is for it and why you've been supporting it for all these years.
It's pretty fundamental now to our offering. We were there from the start as a member, but probably around about 8 years ago, we had to really think about, do we continue to develop our own tools and platform to run the models that we were building, or do we adopt a market standard? And we adopted Oasis. And I think what's great is the benefits and the motivation we see are very well aligned with the motivation of the rest of the market. And some of those core Oasis goals around choice, efficiency, transparency, more innovation align with what we want. And I can summarize almost in 3 main benefits when we said why we're going to go. One is we needed a robust and efficient platform to run our own GCAT probabilistic models. So we now build all those models in Oasis. We deploy those currently via the Verisk Model Exchange platform, and we've adopted the Open Exposure Database as our standard for CAT data. So that gives us consistency. We build all our models, they get deployed in that way. But then we can lay on top of that, the second benefit is we can now license third-party models on the same platform. So instead of having to support multiple platforms from different vendors, we currently are licensing outside of the big vendors in the catastrophe modeling space. We're licensing models from smaller vendors, and we can deploy them on the same platform. And we're evaluating a number of others at the moment. And then the third one is now if we want to make our models available to third parties, before we would have to support and maintain our own platform. Now we can offer up our models to third parties. So we're already licensing some of our flood models to clients who can run those models on their own version of Oasis, or they could consume them through a platform like Model Exchange. So a platform for our own models, the ability to license models from third parties, and now the ability to stand up our models for external clients. So it's become key. And I think it really in the last 5 years has moved to fit for purpose. We are doing this at scale at GC. We're running hundreds of analyses every week from multiple models, multiple vendors. So it's no longer, we're not in the testing this out phase. We're in this, if it goes down, it's a problem for us. And so we rely on our ability to service clients through the suite of models.
Yeah, it's great. It works at so many levels. And it's a good example of where collaboration and competition sometimes have to work side by side. But it's for the benefit of the ultimate benefit is for everybody. So it's great to have supported that. And Matthew, before we wrap up, anything else we haven't talked about that is important to discuss?
Yeah, maybe one thing is just we talked quite a lot about generative AI and the agents, large language models. We are doing quite a bit of research in the area of machine learning. It's been around, obviously, time before predictive modeling. A lot of that's been around before some of the generative AI tools. But there's some really exciting areas we're seeing the benefits. I've talked a lot about NatCat, but I mentioned man-made. We do a lot of work to use what we call computational fluid dynamics to model the impacts of blasts in urban environments, terrorism blasts or other blasts. And that effectively models the physics of an explosion and gives you a much more realistic footprint of the impact of the explosion rather than the traditional concentric ring type analysis we've all done. So you get a more realistic estimate of the damage. What we're now able to do is sort of pre-run a whole bunch of analysis across an urban area like, let's say, Manhattan or London, and capture all those, the impacts for different size of blasts and different location of blasts, and then use machine learning like physics-informed neural networks to effectively mimic the impact of that. And that allows us then very quickly to take a portfolio of risks in Manhattan and calculate, the impact of all those different scenarios accurately enough without having to do the computationally intensive. So we're testing some of that, by the way, on NatCat models as well. So I think that's also interesting that it's, generative AI is the big topic, but we're also seeing in our industry the benefits of some of the machine learning techniques as well.
There's one thing I've always been keeping an eye out for in my career is there ever a convergence between the sophistication that's coming into gaming now, with various online games that have got very high resolution cities, and then you talk about what you're just doing with sort of high resolution fluid dynamics for explosions. Yeah, at some point you've got to believe there's a crossover, the sort of gamification of modeling and learning from what's happening in both worlds. But I don't know whether anybody would actually pay the money to build it or use it. But who knows what might happen, particularly as you kind of build out with the sort of the tools and things. Good. Well, Matthew, that's been great over the years. I've really enjoyed working with Guy Carpenter. Thank you very much for your support for Instech. Even back in my sort of early days of catastrophe modeling in my early 20s, I got to know Guy Carpenter and a lot about the world of insurance and broking. And the lovely thing about this business is, like you and I, there's lots of people who we both knew from all that time ago who are still there and still support us. We talked about collaboration with the platforms, but I think there's a sort of wonderful collaboration amongst the people and a real focus on the knowledge and the intellect is what wins through above everything else. And it's just fantastic to see that continue to flourish and grow, and you're part of it. And we welcome the support of you and others to be part of it too.
Yeah, well, thanks, Matthew. And as my namesake, I think you were one of the first people. I sort of entered the industry relatively late, I guess, at the age of around 30, and you were one of the first people back then that I interacted with. And I've certainly got more grey hair to show for it. I think maybe one of the things people don't know about Guy Carpenter is we just celebrated 2 years ago our 100th anniversary. So Mr. Guy Carpenter, who came up with the idea of pricing cotton on a rolling average basis to take out some of the volatility of the year to year. That's what started it all. So Guy Carpenter's over 100 years. I've got the grey hair to show, but I'm not quite at the 100 yet. But it's been a pleasure to interact with people like yourselves, and now through Instech to get access to a much wider community of talent out there in the industry that we're able to talk to and potentially utilize.
Brilliant. Well, I'm sure there's many more years ahead of us as well. Matthew, I will let you get back to what I know is a very busy job, but thank you for your support.
Well, if you've made it this far, then I'm pretty sure you found that as interesting as I did. The Instech podcast comes out every Sunday morning, where we spotlight the latest news, leading voices, and freshest updates across insurance that you need to know about. If you would like to take part in these conversations, head to www.instech.co to find out how you can join our network and be a part of the insurance intelligence for the curious.